Chapter 12, Some Lessons from Capital Market History. In Chapter 12, we will look at the historical relationship between risk and return. Historical refers to the idea that we are looking at the actual data from the past. So we know what has happened to, let's say, stocks of different companies, and we analyze the data that is available to us from these two perspectives, risk and return. So we will look at return. What is return? How do we calculate return on an investment? And then we will look at historical returns on various types of investments. Then we will look at risk. What is risk? How do we calculate risk on an investment? And again, historical risks on various types of investments. And the last big topic in this chapter will be on why stock prices change all the time. So we finished chapter 10. In chapter 10, we were focusing on how we calculate estimated future cash flows from an investment. If you're wondering what the link is between chapter 10 and chapter 12, well, in chapters 12, 13, and 14, we will focus on the discount rate, right? The rate of return on an investment. Okay, so 12, 13, and 14 have this, discount rate in common as, being the main topic. In chapter 12, we are looking at looking back at the past several decades. What has been earned from different investments, and we, look at the differences. And then in chapters 13 and 14, we will look at sort of how to then apply that knowledge to estimating future return on investment, which is also nothing but the discount rate for, let's say, some project. So let's start with the topic of return. We've been using capital letter R to denote return on an investment. Maybe some of you have been, Googling for some topics to, kind of clarify in your head what certain topics are. Or maybe you've been watching some YouTube videos, whether they're mine or not mine. Maybe you have noticed that depending on the textbook, a different notation may be used for return. So it could be not just capital R, it could be lowercase r, which stands for return. It could be lowercase I, which is also very common. I stands for investment or interest rate, actually. So, it's not always capital R, like in our textbook. It could be other notations, but lowercase r, capital case R, and lowercase I are sort of the most commonly used notations to indicate the return on an investment. So in our book, it's R, capital, and we've actually been given it a lot of different names. You may have realized that we are using different names for the same thing. Discount rate, interest rate, APR, which stands for annual percentage rate. We had this in chapter 6, where we were first looking at nominal versus effective annual rate. Then yield or yield to maturity. This is used for bonds. And we had this term in chapter 7. Rate of return on an investment. So all of these are used kind of interchangeably, and they all indicate the return on some investment. So what do we mean by return on an investment? In this example, in year 0, you invest $100. In year 1, the investment returns $105, right? So how would you calculate the dollar return on this investment? Well, in dollars, you get $5 richer, right? Which is calculated by taking the ending value, 105, and subtracting the beginning value, 100. 105 minus 100 equals $5. But more commonly, the return on investment is calculated in percentage terms. So to calculate the percentage return on investment, we want to take these $5, the return in dollars, and kind of look at it from the point of view of relative to how much we started with, how much richer we got in percentage terms. So we take 5% dollar return and divide it by the initial value or the starting value, how much was invested, right? So 5 divided by 100 equals 0.05 in decimals or 5%. So the return on this investment is $5 or 5%, right? It's 5% of $100 that were invested. Both ways are correct, but typically by return we mean some percentage. The second example, in year 0, the initial investment is $300. In 1 year, this investment returns $360. What's the return on this investment? Well, the dollar return on this investment is 360 minus 300 equals $60. The percentage return on this investment is $60 divided by $300, which is how much we invested. So relative to how much we started with, we got 20% richer, right? The return on our investment was 20%. So 60 over 300 gave 0.2 in decimals, which is the same thing as 20%. In this chapter, we will be primarily talking about returns that companies offer on the stocks and bonds that they sell to investors as a way to raise money, right? Since we are studying corporate finance, this is the appropriate financial investments to focus on, stocks and bonds. Let's look at another example related to figuring out the return on investment. Let's say we are looking at the return on some company's stock. Today you buy a share for $500. Next year, 2 things happen. You receive a $10 dividend from the firm and the shares appreciate to $550, right? So you can sell each share for more money, $50 more. In other words, at any point of time t, you pay some price, which we denote by capital P subscript t, lowercase t. So in this example, it's $500, right? Then at time t plus 1, which basically means 1 time period later, and in our context that's in 1 year, 2 things happen. First, the new price per share is denoted by capital P subscript lowercase t plus 1. And in our example, that's $550. The second thing that you can also receive, right, if you sell your share. So if you sell your share, you got $550 for it, but that's not the only source of income for you over the year. Because on top of that, you also received a $10 dividend. The notation for dividend, as always, is capital letter D, and the subscript to indicate time t plus 1 is t plus 1. So altogether, if you sell your share after 1 year, the total cash received will be $560, which is the sum of the $550 new price at year end and the $10 dividend paid at year end. The dollar return in this example over 1 year is $10 coming from the dividend received plus the difference between the stock price before and after, 550 minus 500. So we get a total of $60. The percentage return over 1 year is those $60 divided by $500 which were invested at the beginning of the year. This equals 0.12 in decimals, which is the same thing as a 12% return on the investment over 1 year. And this slide may look familiar. It already came up in chapter 8, in which we were focusing on stocks and how to calculate the stock price today, as well as how to decompose the annual return on stock investment into the two components that we are also seeing here, the dividend component and the price change component. So in this example, the income that comes from the dividend paid to you is called the dividend income, which is $10. That's capital D subscript T plus 1. The dividend yield is the same thing except expressed in percent. Percent relative to how much was invested at the beginning of the year. So we take $10, divide by $500 and get 2%. That's D T plus 1 divided by P subscript T. So 2% is interpreted as the return on your investment coming just from the dividend paid to you, right? So the dividend paid to you is an extra income to you. And relative to how much you spend to buy the shares of stock, that's a 2% financial gain. But that's not the only way for you to get richer over the year in this particular example. In this particular example, you also have what is called capital gain. That's a $50 increase in stock price. So 550, the new price, minus 500, the original price, equals $50. The ending price minus the beginning price. P subscript T plus 1 minus P subscript T. In percent, you take those $50 and divide them by $500 and get a 10% return. This is known as the capital gains yield. So you take the ending price, subtract the beginning price, and then this difference is divided by the beginning price. Or, like I often explain to my students, new minus old divided by old. If you combine the two sources of your financial gain, the dividend income and the capital gain, you get the total dollar return. So that's $10 plus additional $50 equals $60. In percentage terms, the dividend yield, 2%, plus the capital gains yield, 10%, gives the total percentage return of 12%. And the total percentage return is also the same thing as the total dollar return, $60, divided, as always, by $500 invested at the beginning of the year. So in a way, there are two ways to calculate the total percentage return. The total dollar return divided by the original price paid, or you separately calculate the dividend yield, then the capital gains yield, and then add the two percentages up. To summarize, the total dollar return is the sum of the dividend income and the capital gain. There's also a term known as capital loss. That's when the new price is lower than the old price. So for example, you buy stock for $500 today and next year the price drops, so you lost money. Technically, finance people often call everything capital gain. If there is a loss of money, then the capital gain is a negative number. So a negative capital gain is the same thing as a capital loss. In percentage terms, the total percentage return is the sum of the dividend yield and the capital gains yield. The dividend yield, by definition, is the dividend over the next year divided by the price per share paid today. The capital gains yield, by definition, is the change in price from the beginning to the end of the year divided by the price paid to buy shares of stock at the beginning of the year. And technically, these two you know, yields are coming from this mathematical, you know, trick in which one fraction can be split into the sum of two fractions. So the one fraction I'm talking about is, you know, the sort of the original method of calculating the total percentage return, where you take everything you receive over 1 year, which is the dividend in year t plus 1, and the new price per share, price t plus 1, and you subtract what you paid at the beginning of the year, which is price subscript t. And then you divide that total dollar return, which is essentially what this is, by the price paid at the beginning of the year. So this is how we calculate the total percentage return, which is denoted by capital R. And again, the last few slides should look very familiar because we had exactly that like in the second part of chapter 8 on stocks.